In the last class, we have discussed about income statement of banks, and we have analyzed one by one the components of the income statement as well as balance sheet. Here, the fees earned from fiduciary activities. So many banks, not many banks, all the banks are heavily depends on interest income. In addition to that, banks are providing additional services from which banks are earning non-interest income. Among other services, we will discuss now fees earned from fiduciary activities. Some other, but fiduciary activity mean, for example, a kind of security provide, safeguard, treasury, right? Treasury. The banks undertake someone else's assets as a safeguarder. On behalf of the owner, the bank take the property under their custody for the maintenance. It's kind of what treasury management, securitization, right? So fees for protecting a customer's property. So fees for record keeping, for corporate security transactions, and dispensing interest and dividend payment. Some banks also provide account keeping, record keeping. So now there is the cloud computing. So from the cloud computing, many companies are receiving their services cloud. So for example, in Sri Lankan context, Sri Lanka Telecom provide cloud computing services, and they provide storage services. Likewise, banks also provide some kind of record keeping, right? So record keeping services, fees for record keeping for corporate security transactions. Corporate security means what? Companies sometimes issues shares, bonds, debentures. So on that time, the banks, on behalf of the issuing company, the bank maintain the records regarding the financial securities traded in the market, in the primary market or secondary market or other system of exchange. So banks keep all such records, and banks pays dividend. In case of bond, bank pays in case of bond, the bank pays interest. In case of equity shares or preference shares, the bank distribute dividends from this account. So this kind of activity done by the bank on behalf of their respective corporations. So for record keeping, for fees for record keeping for corporate security transactions, and dispensing interest and dividend payment on that. So fees for managing an individual pension and retirement plan. So in large companies, we can find there are many employees are working there. So at the time of retirement, the companies, such large companies, employers should give certain payments. So gratuity payment and pension, EPF, ETF, so that kind of things. So they are doing based on their provisions of some relevant act in particular judiciary system. So sometimes such companies, such large companies may face difficulties to manage that kind of fund, pension fund, retirement schemes. So on behalf of the such corporation, such companies, the bank undertake that services. So such that the bank may provide that pension scheme and retirement plans in effective manner. So every month they will deduct a certain percentage of their certain amount of money from their salary every month. So they have in this way they can provide some kind of services. For the services, the bank earn money, fees earned from fiduciary activities. So it's a non-interest income. And service charges on deposit account. So normally people, general public like me and you deposit money in a bank account, say saving account, right? And time to time bank deduct small fee from our account, so like service charges or internet banking charges or debit card charges or passbook charges or insurance. So there are so many charges, so they have a list. So service charges on deposit accounts. So checking account maintenance fees. So if anybody keep demand deposit current account, they may charge checking account maintenance fees, and checking account overdraft fees, OD. So bank overdraft, checking accounts, current account, and fees for writing excessive checks. So some people utilizes the check abnormally. For that time the bank may face some kind of burden, difficulty. For that the banks charge some fees on that activities. And saving account overdraft fees. In some jurisdiction, in some countries, deposit account holder also, saving account holder also can write checks. So fees for stopping payment of checks. So some people write the check some later date. So later on they may realize that they don't have enough money in the account. So in such instances, the account holder may inform to the bank to stop their payment to the relevant check, or due to other business reasons the checker may want to instruct the bank to stop the check. So on that services the bank deducts some fees. So it's also coming under the non-interest income. Trading account gain and fees. Trading account mean normally banks invest their money on buying securities in the stock market or other capital markets. So buy securities at lower price and sell the securities at higher prices. Due to this trading, the banks may enjoy capital gain. So net gain and losses from trading cash instrument and off balance sheet derivatives contract that have been recognized during the accounting period. Not only share, equity shares, premium shares and bond. Beyond that, so as we discussed, swap and forward contract, hedging, so different hedging, and options, put option, pull option. So there are different types of derivatives. So that so the banks may involve in buying and selling that kind of securities. So from that they can earn some sort of income. An additional non-interest income. So in investment banking, advisory, brokerage and underwriting. So we have discussed in the first chapter what is the investment banking activity, advisory and brokerage, underwriting in detail manner we have discussed. So by providing this kind of services, the bank may get additional income. Venture capital revenue. Venture capital, we have discussed earlier in the first chapter. If anybody wanted to start up a new business, but that time the business startup person, the entrepreneur does not have enough money At that time, the banks come forward and give money to start up the business. For that, the bank requires some amount of revenue from the profit of their business, venture capital business. And net servicing fees and net securitization income. Securitization means what? They are making portfolio of stocks. So portfolio of stocks. So they make some portfolios. Portfolio means what? The collection of shares, the investment, collection of investment. Say the investment consists of 100 shares in company X, 200 shares in company Y, 500 shares in company P, and 600 shares in company D, like that. So they have make a certain portfolio. So they banks create this kind of portfolios and sell to its customers. Due to this kind of securitization, the bank make income. Insurance commission fees and income. So the insurance companies and banks come together and they work together for each of their benefits. On behalf of the insurance company, the bank collect money from their customers, premium, and through this premium, banks, insurance companies get their dues on time, and the banks get the commission fees on collected money from its customers, insurance customers. And net gain or loss on sale of loan, net gain or loss on sale of real estates, or net gain or loss on sale of other assets. So these are the ways of earning non-interest income. So when you look at the income statement, first at the top you can find net interest income. Net interest income is calculated from interest income minus interest expenses. It's called net interest income. From that we deduct the provision for loan losses. After that we will get net income after provision of loan losses. And so if there are any non-interest income, if it is positive amount, then we can deduct, so we can add with this balance, and we will get net income before taxes. And if there are any losses due to the security gains, security trading account gains or losses, so it have to make adjustments, and again we deduct taxes and income and after deduct taxes, then we will get income before extraordinary items, and again deduct extraordinary items losses. If it is a gain, we have to make it plus, and finally we will get net income. So in the profit loss account you may find net profit, like that, net income. Then if there are any dividend announcement, then you can deduct dividends, and finally undivided profit. It's called what? Retained profit. So this is the typical income statement I have explained in detail in the previous class. So features and consequences of bank statements. So these are the key features. So for example, heavy dependence on borrowed fund supplied by others increase the use of financial leverage. It means, so normally banks depends on deposit of its customers, and the banks convert this deposit into loans to its customer and then earn interest income. Here the situation is the banks is heavily depends on borrowed fund, not on deposits. So what will happen? What is the consequence of this? So it leads to what? The consequence is the bank's earning will be at risk if bank cannot repay those borrowing in due time. So the banks itself are treated as a debtor, so credit, right? The bank itself taken loan from other bank or from other financial institutions. So in that time, the banks also should pay interest on that money, borrowed money from such institutions. So if such borrowed money is in a higher level, so the bank sometimes faces risk. They are unable to pay interest and its borrowed principals. So it must hold a significant proportion of high quality marketable assets to meet its most pressing debt obligations. So that time the loan provider make pressure on a bank. In such circumstances, the banks should try to sell their marketable assets. And most revenue stem from interest on loan and securities. The largest expenses item is the interest cost. Here, so revenue from interest on loan. It's normal, no? So the largest expenses item is the interest cost, right? So mainly depends on deposit and mainly depends on loan. Loan is an asset for the bank. So bank management must choose a loan and investment carefully to avoid high proportion of earning assets that fail to pay out as planned. The bank's income totally depends on a loan provided to its customer, and also the bank depends on heavily on deposits. For the deposit holders, the bank should pay interest as an expense, and from the loan the bank will get interest. So what's the consequence of this? So imagine that a bank's customer who is borrowed money from a particular bank make loss, then they fall in loss. So he unable to settle the money to our bank. So what will happen? So our bank will unable to collect money from that particular customer. So the bank manager had to take a special care in this situation when granting loan to its customers. So must be competent to protect against losses due to interest rate movements. So in addition to that, in the market there's a chances to fluctuate interest rate and exchange rate or other things. So in that times the value of the loan, so the interest expenses may differ. So that time the bank may be under the risk. So likewise here, greatest proportion of asset is devoted to financial assets, relatively fixed assets, and tend to make limited use of operating leverage. So they have heavily invest on financial instruments, financial assets. Loans are financial asset, and investment in the stocks, investment in the bond. So it's a financial assets. So the banks is heavily depends on such financial assets. So the consequences, financial firms earnings are less sensitive to fluctuation in sales volume, so operating revenue, than those of many other businesses. You might study about the financing leverage, operating leverage, overall leverage. So here the banks is heavily they are not utilizing the operating leverage properly. So this time the banks should manage extra care on this. So cash flow. So how the money comes into the bank, how company goes from the bank. So sources, capital flow, source and uses. Sources mean where the money is coming from, and the uses mean how the money is going out from the bank. So a typical source where the cash is inflow to the bank: sales of assets, sale of financial instruments, sale of securities. Decreases in assets. Decrease in asset mean sale of assets. When they sell assets, then they will get money. So this sale of asset may decrease their assets. And increase its liabilities. Increase its liabilities mean the bank get loan or bank get deposits. It's a liability. In future, the bank have to settle that. So increases in capital account. So the bank, what can do is they can increase the equity capital or stated capital. So this is how the bank can get money into the bank. And typical use of cash, how the company will go out from the bank. So this is what is kind of cash flow statement. So expenses, salary, wages, interest expenses, like that. Increase in assets. So bank purchase assets. So with that the company's money, the bank's money will go out. And decrease in liabilities. So settle the bank loan and settle the deposits. And decreases in capital account. So dividends, withdrawal, reserves, like this kind of stuff. So second part of this chapter, that is evaluating performance.